Good morning, this is Larry Edelson with my Uncommon Wisdom video update for Thursday, September 17th. We've got some fireworks going on here. Gold continues to muster up some strength after pulling back earlier this week to below $1,000 an ounce. It is now solidly above the $1,000 mark at $1,020. You should be able to see it here on this chart, which I'll maximize for you. This is the same chart that I've been looking at with you over the last few weeks. You can see, if you've been following me, the cyclical trend channel that I've drawn in for you and the previous cyclical downtrend line. You can see how gold broke above it last week and then traded down to test support. Even held this 10-day exponential moving average, and now it is at a new high. However, I am still skeptical of this gold rally. It is not, in my opinion, the big one. We could see a new record high in gold, even up to about $1,037, $1,040. But I do not believe, based on all of my cyclical studies and technical indicators, that this is the runaway bull market phase of gold, where you're going to see $1,200, $1,300, $1,400, $1,500 gold and higher. That, no doubt, will be coming, but we're about a year away from that, in my opinion. It's far more likely that gold will either top out here or suck everybody in by making a new high around $1,040, $1,050. And as tempting as it is to jump on board this gold rally very aggressively, I think it would be a mistake, because it's far more likely that gold will top out in here, then pull back sharply to shake out all the weak longs and the weak last Johnny-come-lately buyers, and then later next year begin the real leg up in gold to $1,500 to then to $2,200 and possibly even higher. What is driving gold right now? What's driving gold is concerns about the dollar. I'm going to pull this chart back to you. I'm going to go to the dollar right now. Let me click on it over here. It should bring up a dollar chart momentarily. Let me just rearrange the screen for you. Okay, there we go. This is also the same chart that I've been showing you on the dollar over the last couple of weeks, and you can see that it's fallen below this channel, which we saw last week. It hasn't made any major progress to the downside, but then again, it hasn't popped back up inside of this channel into this range here. So it's showing definite short-term weakness. We know the long-term is weak. We know that we're in a major bear market in the dollar. However, just like gold, I have several technical indicators that tell me this is not yet the big move down in the dollar. So I'm as bearish as I am on the dollar. I am not super bearish in the short term. I need more evidence to confirm that this is the blowout to the downside in the dollar. I don't believe it is. I believe it's a fake out move, and it's tough for a lot of you to see through these things. You know, I'm super bullish on gold, I'm super bearish on dollar, so why aren't I, super bullish on the short term in gold and super bearish on the short term in the dollar? I can just tell you, it's what my signals are telling me, it's what my technical signals are telling me, it's what the cycle charts are telling me, and it's what my personal gut experience is. If I'm wrong, we will know soon enough. Then believe me, we have plenty of downside in the dollar where we can make some profits, and plenty of upside in the gold as well. So I don't mind staying out or on the sidelines until I see more confirmation that this is the big one in the dollar and in gold. And so far, I have no confirmation whatsoever. Let's switch over now to the Dow. I'll call up a chart there. The Dow is very firm. Not surprising. There's been a lot of positive good news out. That hasn't been very surprising either. We've forecasted it because the cycles are in the Dow's wins and in the economy's wins. So we're seeing here, it almost looks like gold. The Dow almost looks like gold, rallying up here. Slightly different formation, but I showed you this break line in the past. We took above it, we came down reasonably close to it to test it, and then we ran to the upside here. I believe the Dow, as I've been saying since March, will get over 10,000, but I think that's about it. So this rally may be soon running out of steam in the Dow, and we may actually see the Dow soon enough begin to pull back, and also along simultaneously with gold. The Dow and gold are acting very similarly here, and both going up together and both going down together. An important note I'd like to address: you by now all heard Bernanke's statement yesterday at the Brookings Institution, where he gave a speech that he believes the recession is technically over. I agree with him. I forecast that several months ago. However, I want to point something out. If it's truly over, if the recession is really over, it's only because Bernanke knows that he is going to systematically, one way or another, devalue the dollar over the next few years, and that nominally, in terms of nominal figures, the economy is going to look like it's improving, the economy is going to look like it's growing again. Stocks may continue higher after, of course, a short-term pullback here. But what in reality he's doing is devaluing the dollar and inflating or reinflating asset prices and inflating away the debt. The economy has actually been in a recession from a real perspective in terms of real figures since 1999. We are in the 10th year of a recession, and I will be writing about that shortly, so stay tuned to my columns so that you can see that the economy has had no real net growth in 10 years and has actually been declining. Stocks have also been in a bear market for 10 years, actually, in terms of real terms. So we've got some very interesting things going on here, and I want you to really use some uncommon thought, and I'll help you there in my writings and in my videos to see through what's going on. Because if you don't see through what's going on and look at things in a unconventional way these days, and with what I call dynamic thinking instead of linear thinking, you're going to face the prospects of severely diminished wealth, even more so than we've had over the last few years, instead of profiting from this situation and instead of protecting your wealth. So I want you to think completely differently about what's going on, and I want you to also think about real values versus nominal values. I want you to think about the dollar and how it's nothing more than an elastic rubber band, and if its value goes down, then even if prices go up, you may not be making any money. And I'll give you a quick example of that. Suppose you ran out and bought a house tomorrow and you paid $100,000, and then the dollar lost 50% of its value the next morning. What would the value of that house have to go up to for you to make a net profit? It would have to more than double to $200,000 for you to make a profit, because the dollar's lost 50% of its value. That's a little bit complicated to understand, but I'm going to show you that in my upcoming columns and be talking about it at length. So this is Larry. Have a good weekend, and I'll talk to you again soon. Be sure to read my Monday column, and also, if you're a Real Wealth subscriber, my September issue goes to press tomorrow. Actually, it goes to press this week. It'll be out there for the public on Friday evening. Till next week, this is Larry.